morning. This is Mortgage Pros 411. I'm Audrey Boiseneau. I'm here with my co-host Kevin Casey, and we are joined today by Dan Habib with Mortgage MBS Highway. MBS Highway. See how I did that, Dan? MBS
Yep.
Highway.
Well,
Welcome.
hey guys, pleasure to be with you.
Thanks for being here. Just briefly, we have an NMLS class that is live in Thousand Oaks, being put on by the Greater Ventura chapter of Camp on September 22nd. Kevin and I will be teaching it. Let me tell you something. Those are not well, I won't say normal boring classes. Those are classes that have a little more information than the average class might. So it's fun. We hope you join us there. Live is really, really great these days. So anyway, we hope you sign up and we see you there. And then last week, who was our guest, Kevin?
Our guest, we had Glenn Stearns.
Glenn Stearns and his wife, Mindy, and they were absolutely great. You can check it out on our YouTube channel, Mortgage Pros 411, along with everything else other than our little sessions with the CFPB. You can put it on 1.5 speed and make it go faster, which is very fun. It'll be like listening to the Chipmunks give you the Mortgage Pros 411 rundown.
Actually, last week I loved Mindy's speed up. She had it perfect, like how she did it was amazing.
Well, she's a trained professional. She was on Entertainment Tonight. She was on the news. She was like, these people, this was not their first go round. I mean,
no, wasn't their first rodeo?
But their message was great. And right now, it's really important. Mindset is everything. It's your mindset. It's not what the market's doing, what the rates are doing. It's none of that. It's how are you thinking about it and dealing with it. And so, Dan, do you remember a few months ago when we told you that I told you I was so sick of the word recession. We were going to turn it into a drinking game. So every time someone said the R word, you had to take a shot. But then we realized we wouldn't make it through the hour. We'd be on the floor completely passed out. So we had to shelve that little plan. But even though we stopped that, I mean, the news has been crappy for so long. And a few weeks ago, we're like, okay, sunshine and unicorns. We got to talk about what's good, how to grow your business, how to focus away from the insane fluctuations. And that is really what we like to focus on at this point. But weirdly, right leading up to when you're going to join us today, what happens to the bond market? What happens to rates? All of a sudden, we're seeing green instead of red. What is going on? 45 basis points today? What is happening?
Yeah, so we got some bond-friendly news today, and it is good timing because there's been a lot that's happened since the last time we talked, and there's a lot that's happening this week. So, just to kind of lay out some of the things that I think would be good to talk about today would certainly be what's causing the rise in the bond market today, and that was weaker consumer confidence numbers, as well as weaker job openings. And of course, that's ahead of the big BLS jobs report Friday. But we also just had the Jackson Hole meeting with the Fed. So I want to kind of talk a little bit about what's been happening there and what we think the Fed needs to see to really slow down or to stop putting their foot on the economic brake, so to speak. And also, we have a lot of short interest in the 10-year out there. And I think we're potentially getting close to seeing a bit of a short squeeze, which could help things so long as the jobs data, cooperates. And then, of course, we got some great housing news today. And I'm happy to share some of those numbers with you because according to almost all the appreciation reports out there, for all the naysayers saying we're going to have a housing bubble, we're seeing new all-time highs in all these appreciation reports. Now, I know there's a double-edged sword there as far as, listen, rates are high and home values are going up, certainly can hurt affordability. But from the opportunity out there in home ownership, there's two ways to look at housing, right? There's housing, the economic driver, the transactions that are occurring, how that contributes to GDP, makes up 15, 18%. But then there's also housing, the investment. And I think that's what our customers care about most. And it's certainly proven to be a good investment as we're seeing appreciation accelerate in some of these reports. And, we're seeing new all-time highs in home prices, certainly not seeing a 25, 30% decline like many out there had forecasted.
Right.
But we're also not seeing a 20-25% appreciation either. It's a good
which thank God for that. We don't want to see, we don't want to have it too little, too big. We want it just right.
Well, let's take it step by step here. And why don't we talk about what's happening in the bond market right now, right? So I want to just share my screen. If you could give me the, I call it the Schloman shield down there.
Before, I mean, this is always a fiasco for God's sake. Hang on. There it is. It's under the share screen tab.
I still don't have it yet.
I know that's because I haven't clicked it yet. Okay, how about now?
Okay, I got it. So
Okay, great.
quick little live look at the bond market here, team, and mortgage-backed securities. We are up 46 basis points. And boy, we have had a nice last week. It's been a little bit sideways for some of it, but we've had a nice rally. And this is something that has been a bit rare to see in the bond market. It seems like pricing's just gotten beaten up so much, but this was welcome. And the 10-year, after holding at a critical level at this 4.335 ceiling of resistance, we've seen yields now come down and they're challenging their 25-day moving average. It went from 4.335, actually a little higher than that it got to, which, by the way, that matched the high that we saw in October. But then before that, you'd have to go back almost 16 years to see a higher 10-year yield. So it was critical that we held at some of these levels. We ended up doing so, and now yields are back down to 4.12 on the 10-year. Certainly, we'd like to see them lower, but this was a good first step. Now, what caused this? Well, we got some economic data out today that was, I think, very important. So we know that we just had the Jackson Hole meeting this past week, and that's where central bankers from around the globe went to Jackson Hole, Wyoming for their symposium there. And they were all talking about their respective areas, inflation, their central bank policies. Of course, Powell, who spoke on Friday, is the most important for us, talking about the United States. And he talked about how inflation's been coming down. If we take a look at, and I'll just pull this down for a quick sec. So as he talked about how, hey, first they were looking at the headline consumer price index or headline inflation, which factors in everything, because he said, hey, that's what the consumer feels the most. Well, if we take a look at that, it went from 9% to 3.2. Really big progress. If we take a look at the core index, which strips out food and energy prices, and the Fed likes to look at that one because that's what they feel they can impact with their monetary policy, because, hey, there could be geopolitical stuff happening. OPEC could, cut production, and they can't necessarily impact oil or food prices. Maybe there's a drought or some weather conditions, right? So they like to look at core so they could see if they're making impact. That's gone down, not as fast, but from 6.6% to 4.7%. And then they talked about the super core, and they said, well, let's take a look at core, which strips out food and energy, and remove shelter, because the Fed, I think, is smart enough to know that the reason why inflation is higher right now is because shelter costs, which make up 43.5% of the core inflation reports, have been lagging severely behind, and they always do. And it's because of the way, number one, they calculate the data over the last year, but also rents don't turn over that frequently. So it takes time for that to be captured. Guess what? If you strip all that out, super core is running at 1.6% annualized. So that's below the Fed's target right now. Wow. The Fed stopped talking about that now. So it's clear through Jerome Powell's comments that he had at Jackson Hole that inflation coming down isn't enough, because it's clearly on the right trajectory. It's clearly already made big progress. And typically when you see inflation come down that much, if you look historically, you would see such a better reaction in the bond market. In fact, when we've seen inflation come down by like amounts in the past, the 10-year would drop by 120 basis points or 1.2%. Instead, it's gone up by 1%, right? I think a lot of this has to do with the Fed, what they're doing, their posturing, but also there's external factors out there. You have other central banks like Japan easing on their yield curve control. You have a lot of supply of bonds in the bond market, of treasuries from our government because of new debt ceiling deals and things that need to be paid for in the 1.5 billion range, right? So that supply has to be absorbed, even if it's not on the longer end. It's still a liquidity drain. You've had banks selling of assets like mortgage-backed securities and treasuries to come up with depositor money. So listen, it's been one of the wildest kind of markets to, I think, interpret and forecast since I've been doing this, which, maybe not as old as some out there, but it's been about 15 years. So it's been very, very interesting. But what I got from Powell's comments are that he acknowledged that inflation has come down. Still, they're not convinced yet it's heading to their 2% target. But the big thing he said he needs to see is weaker labor numbers. And that means he needs to see the jobs report show lower job creations. And, we were just talking before we went live on this call, how infuriating the jobs report is. And I'll tell you from my perspective, why. Every month we get from the BLS, usually the first Friday of each month, their big jobs report. Really good metric on the health of the economy. How many jobs were created? What's the unemployment rate? How much are wages going up? Well, they come out with the numbers and they use a ton of modeling and estimates. And listen, it's a Herculean task to come up with the jobs figures for the entire United States and for it to be accurate. But what really kind of grinds my gears is they use some of these metrics like things called the birth death model. So what they're actually trying to do is look at different sectors and estimate how many businesses in those sectors came online versus offline and about how many jobs net that accounts for. It always does a terrible job at inflection points in the market of giving you good data, but it's also the reason why, and you might notice if you follow along, every month when you get a new jobs report, the previous 2 months are revised. And they're not just revised by a small amount. If you look this year,
It swings.
this year on average, we have seen 46,000 in negative revisions per month. So that means that they overstated the jobs by 50,000 every single month of this year, which is big. But how about this? 2 times a year, they also review from the previous year numbers, and they looked at the last 12 months and they said, oh, we're revising them down by 306,000. So the reason why it upsets me is this, is that we come out with what we think's happening in the market. And while the jobs number comes out and it blows out estimates.
Yep.
And it makes it look like, hey, we didn't get this right. But then by the time they revise this thing 4 or 5 times, we were correct. But it doesn't matter. It doesn't matter. It's in the past now, and the market's reacting to the more current numbers, right? So it's very difficult with their standard deviation or their error that they have there. But what I've noticed is that the Fed's not looking at the internals. Otherwise, I don't think they would have the stance that they do. So if you look under the hood and you get rid of the birth death model in there and you take a look at some of the other metrics, boy, job growth has been pretty much flat from the beginning of the year, meaning like no net new jobs. You've seen a lot of short part-time workers versus full-time workers. We actually saw in the last one a decline of a lot of full-time workers. Hours worked is something that doesn't get enough attention. So when you take a look at an average work week, right? On average, you would think it's like 40 hours, but in the United States, it's like 34.3 hours. That has come down significantly over the last year. So why is that important? Well, what are ways that companies can cut costs? They can lay workers off, but we know there's not a lot of skilled workers out there. They've been complaining about finding good matches for that. So to cut costs, they can cut hours. Yeah. But when you see these jobs reports and it's like, oh, they cut 0.5 hours, 30 minutes, it doesn't sound like that much, right? But across 165 million people, that's an average. Wow. You're talking about what would extrapolate to like over 1 million jobs, right? Mm-hmm. So if you were to say, hey, that time across that labor force, how many full-time workers would that be? So it's actually quite significant, and it shows you that overall output in the economy is less than it was because of that. But that doesn't get any attention, but it certainly, to me, shows some weakening. You also saw a big decline in temp workers over the last 6 months. That's usually a forward-looking indicator for what's going to happen with jobs. The unemployment rate, this one's been stubbornly low, but you have to remember with the unemployment rate, a lot of it has to do with the labor force, right? So you have your numerator and your denominator. You have unemployed over the labor force. A lot of times when we've seen this unemployment rate get better, it wasn't for the right reasons. It was because people are leaving the labor force. And, this is something that helps the unemployment rate to come down. So there's a lot of idiosyncrasies to this report. But what the biggest thing for us is going to be is for us to start getting some weak headline job creation numbers, because I don't think Powell and the Fed are looking at the internals like we are and saying, oh, it's actually quite weaker under the surface. So we have one coming out on Friday. The estimates are for 170,000 job creations. You can see the bar's been getting a little bit lower, and we've been seeing job creations trend lower. But if we can see like a real stinker of a jobs number here, I think that would be huge for the bond market, and it would be huge for the Fed, because I think then they can kind of change their position and pause for good. We know that they're going to want to stay higher for longer, but there's still a lot of fear the Fed's going to hike September 20th. So that's the key. And one of the things that we got today that helped the bond market was this report, because the markets know this is really what the Fed's focused on, and this is the big item. So they know the jobs report's important, but we got JOLTS for the month of July. So JOLTS is job openings and labor turnover survey, right? So this actually is showing you how many job openings there were in July. You could see what's happened with the trajectory. It actually went from 2 months ago, like 9.5 million down to 8.8 million. Now, there's still a lot of job openings out there, but that is a non-insignificant decline. And because this was job openings in July, many people thinking, well, hey, maybe there'll be less hiring in the month of August, and maybe we'll get a little bit of a weaker jobs number. Now, you might look at this and say, well, Dan, 8.8 million, while it's declined from the peak, it's still so much higher than the pre-COVID trend. Why? It's a different world. You're not looking at apples to apples here, because you have to remember, pre-COVID, there wasn't this work from anywhere. And when you take a look at job openings, what businesses are doing is they are posting the same job in multiple states. I also found out from the CEO of ZipRecruiter that they are using, and this is a hat tip to Peter Bookvar, our good friend who told us about this a little earlier today. He actually heard it from the CEO of ZipRecruiter, that they're also doing the same job with different titles to see which keywords hit. So there is a huge overstatement of actual job openings out there, which is why you can't really compare it to the pre-COVID trend, because it's a different work environment. You could work in any state for a lot of jobs now, so they get multiple counted. So overall, I think we're seeing what's happening with the trajectory here. And I spoke with Lacey Hunt, Dr. Lacey Hunt, one of the most brilliant guys out there. You know, he's a good friend, and he also ran the most successful bond fund of all time. And he said that from a lot of the things he's looking at, he is seeing a lot of weak internals for the August jobs data, which again, we'll get Friday, but he's not 100% sure it's going to get captured in this jobs report, but fingers crossed that it does, because if it gets captured, I think you're going to see a big run up in the bond market. You might start seeing people think the Fed is maybe going to be holding off from further hikes and such, because this is the one thing that the Fed really hasn't seen yet. They've seen inflation come down. They're waiting on the labor picture to cool off. And then the other thing that helped us this morning was consumer confidence. Consumer confidence fell from like 116 or so to 107, so 117 to 106, excuse me. And that was a big decline. And then the other thing is, if you look at the future expectations, this blue line here, it just fell to a level of 80. And that is a recession indicator whenever you see this. So you put those two economic reports together, especially the jobs data, the bond markets had a little bit of a relief rally today and continued really what they were doing earlier in the week. So that was, you know, some of the stuff I wanted to just pause there and let you guys talk for a minute here on some of the economic data that we were seeing to give us a good market reaction. And of course, the big item being Friday's jobs report.
Well, I have politely suggested multiple times to economists that we should change the BLS jobs report to the BS jobs report. And just the L means nothing. The BS is really what we should focus on, because it has been like this for years and years and years, and it is just now being talked about. And so I'm thinking if we could put together a little lunch and learn on Zoom, maybe we can like do what we did in COVID, which is you ship in lunch to each of these people sitting at their desks ahead of time and get those 400 PhDs at the Fed on and teach them a little bit about what's actually going on in these jobs reports. Because I find it infuriating that Fed is costing us billions of dollars a year. You've got all these super uber educated people who cannot understand what simple old me can understand. So,
well, you know why that is, because PhDs never work. They just went to school all the time that we were working, and therefore they don't get the real world.
Well, listen, there's certainly a lot of academics there, like you said. You know, we've certainly been critical of the Fed. And listen, I don't envy their job, okay? But
I don't want to do their job.
It would be
either.
boring.
But
very boring. That's their job. No,
but certainly their track
kidding.
record is one where they typically overcorrect, right? So they either, you know, they're, you know, one of the sayings we like to use is that when you're driving down the road, you want to be looking through the front mirror, right? The front window, right? And it seems like the Fed, you know, they say they're data dependent, but all their data lags. They don't really have good foresight. And it's more like they're driving down the road while looking in the rearview mirror, right? Because they're looking at things that are lagging, that have already happened. And, you know, the Fed, they made the same mistake in 2021 when inflation started to rise. And you remember back then, Powell was saying, oh, inflation's transitory. We don't have to worry about it, which means it's temporary.
Vividly.
You know, it doesn't take a PhD to figure out if you have 5.2 trillion in stimulus, all kinds of government spending, and you have the Fed buying trillions in mortgage bonds and treasuries to inject liquidity and keep rates low and promote expansion, and you have supply chains crippled, that you might have an inflation problem. But they waited too long. I think they could have really avoided a lot of this inflation if they would have acted earlier. So, okay, you got away from them. They were known as the Fed that kind of messed up this 40+ year high inflation. Well, now I think they're trying to protect their reputation a little bit here and make sure they don't make the same mistake twice. And they want to make sure they really have inflation under control, even though, I mean, you look historically, like look at Paul Volcker. You know, he was a Fed, you know, the Fed never waits for inflation to get down to 2% before they start cutting rates. They have the foresight to see typically what's happening with the trend of it. And, you know, on the trajectory we're on, and you consider the lags with shelter and how once that catches up, that's going to impact inflation. You take a look at some of the things I'm seeing out there that really are recessionary. You know, I don't think the Fed needs to hike again. I don't think they needed to hike at the last meeting either. I think they've done enough. And, you know, the Fed talks about this often. They want to have a restrictive rate, right? So what does that mean? Well, they want the Fed funds rate to be somewhere between 2.2 and 2.4% or so above the inflation rate. Well, inflation's been coming down. Even if they just leave their Fed funds rate where it is, it's going to continue to get more restrictive. But right now, they're at like 5.5% on the Fed funds rate. And, inflation, depending on which metric you're looking at, is, 3.2% on the headline CPI, or, 3% on the headline PCE. Even if you look at the core numbers, which are a little bit higher, you're still at a highly restrictive rate. I think they just need to be a little bit patient here. And, of course, when the Fed gets out there and they don't give a lot of confidence that inflation's under control, they're talking about, continuing to roll off their balance sheet, maybe continuing to hike. The markets don't like that. And it's certainly not good for the bond market. So it's definitely frustrating. But if you look historically, the Fed, they always overcorrect. They hike too much. They send the US into a recession. And then they're too soft and too accommodative on the other side of things. And they cause these boom and bust cycles.
Right.
And, that's why we're critical of them. But it's not an easy
fascinated.
job for sure.
I'm fascinated by the fact that you can have all these different they're presidents, right? Fed presidents, Mary.
So you have
And-
your Fed presidents, right? You have the chair, the vice
Yeah.
chair, you have the presidents, and four of those presidents, they rotate. Four of them are voting, right,
Right.
each year. And then you have your Fed governors who are always voting. And then the New York Fed president, because that's such an important role there where they do their market operations,
Right.
they're always voting as well.
Right. So
Yeah.
I find it interesting that they're all presumably looking at similar data, but they all have completely different conclusions after reviewing that data. So you'll hear one of them say one thing, the other one saying another thing. And
Well,
the fact that they have a hard time coming to consensus is really remarkable. And I just wonder, like, how can that be? Like,
They're looking at different markets. You got a St. Louis Fed, you got a San Francisco Fed. I mean,
yeah, but they don't
Yeah.
just look at
Well,
San Francisco's data only. I mean, that makes zero sense. You have
Well,
to look
they just have
nationally.
different opinions on the market too, right? So when you look at the Fed, you have your hawks and your doves, and it's always been that way. And then you have like your centrists, right? Where almost like politics, right? You have people on each side, right? So for the Fed, you have your hawks. They want more tight monetary policy, right? And then you have your doves who want more accommodative monetary policy. So your hawks would be in favor of more hikes. Your doves would be in favor of more buying of mortgage bonds and treasuries, less hikes, right? Cutting rates sooner. So there's always been kind of this somewhat balance between the different factions there within the Fed. But you're right, the data is all the same, but they just have different opinions on, and monetary policy is not an easy thing to kind of predict out because there are significant lags that it's not an exact science, right? I mean,
Right,
many people out there talk about how there's we haven't felt the full impact of the Fed's rate hikes from near zero, 0 to 0.25% to 5.25%, 5.5%. We haven't felt that impact. And some people say it could take 18 months for that lag
Right.
to fully be felt by the economy. So it's a tough thing to predict, but I certainly think that they've already done more than enough and need to kind of pull their foot off the economic brakes.
Well, and on that note, I just want to take a moment for those people who are looking at folks like you who are making evaluations of the market and trying to guide people as far as what's coming next. There are going to be missteps because we can't always see what's coming next. So you can have out of nowhere, a debt ceiling crisis, or some country invades another country, or, all these things that have nothing to do with the technicals in the market, and they're going to impact our market and our rates. And so, hanging our hat on some forecast for the future, don't do that. Like, we take the information on a day-to-day basis. We let our clients know what the reality is versus the, headlines that they're seeing, and appreciate that we actually have an understanding of things, but don't get mad at the person who unless they're consistently making crappy forecasts. I mean, I think it's a dangerous game, frankly. I mean, years ago, Kevin, do you remember Kevin was like, oh, we should make some forecasts. I'm like, not a chance. Nope, 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 no chance.
Well, listen,
Anyway,
the
and
problem
boy,
with forecasts is that, I mean, when you put your guesstimates out there, your forecasts out there, right? You're not always going to be right. And
Yep.
listen, we at MBS Highway, we thought rates were going to be lower right now than they are. We thought that, we would start to see inflation turn around, and as it did historically, that would be a main driver for lower rates. We did get inflation to come down as we wanted to, but certainly, as you guys all know, rates have been pesky, much higher, right? Stubbornly high.
but
I mean,
it doesn't
there was
always correlate to what happened before. And so, I mean, I think we're in such a different market and such a different environment with the levers that are being pulled are reacting differently than they reacted in the past. And so, it's uncharted territory, frankly, because we've got such a different economy right now. Of course, things are gonna just happen.
Yeah, there's a lot of external factors that, were
Mhm.
clearly
There's a
unforeseen, right?
lot.
But I do think that we will hopefully this week, but if we don't in the coming reports see a weakening labor market that's more reflective of what's actually happening out there in the reports, I think that'll be a big help. I think the Fed will finally get the picture and start, at least not hiking additionally and probably stay restricted. But I also think the biggest thing that would help rates would be a recession. And there's a lot of indicators that I'm seeing out there, even though some people now have said, oh, I think we're going to have a soft landing. I think actually that's precisely the time when now that people are feeling that we're going to get one. But a lot of the things I'm seeing out there, whether it's leading economic indicators negative for 16 months, any of the manufacturing reports that come out have been deeply, deeply negative. I mean, right now it's interesting because you have certain sectors in the economy that are clearly in a recession and certain ones that are a little bit stronger. But any of the confidence indexes out there, yield curve inversions, you name it, all of these different things. And I think sometimes people get blindsided by recessions because sometimes they can come on really quickly, So if you look back to 08, 09, a lot of what we're seeing right now was happening in 07. And people are like not seeing the recession coming. And then it comes quicker than you can imagine. Right. So, but big difference here is that the housing market, to kind of pivot to some good news, has been really resilient and really strong from an investment perspective. So this morning we got the Case-Shiller home price index, which is really looked at as like the gold standard for appreciation, as well as the FHFA house price index. Now, those are two really good appreciation reports. The difference between the two, FHFA doesn't include cash transactions, and it looks at homes with conforming loan limits. So, most of the time it'll be your cheaper priced homes. Doesn't have to be, right? But you could have a much higher mortgage on a different home, but a lot of times it's maybe your lower crop. So Case-Shiller is looked at as the gold standard because it takes into account all homes, while FHFA, no cash and conforming loan limits. But I want to just share with you a chart of what we're seeing out there. And this is a good one for you guys to talk about because there's a lot of doom and gloom in the media like usual. Remember, there was a lot of these pundits out there and even people in our own industry saying, oh, home prices are going to come down 25, 30%. Just a little recap. 2022, home values went up 9% in the first 6 months, peaked in June. Then everybody was talking about how home prices were going to move lower. Sure, they cooled off, depending on the report, somewhere between 3% to pretty much 1%, depending on which one you were looking at. But let's just call it 3% from June to December. Full year 2022, please remember, we still saw home prices rise 6%. So what's happened since then? Well, Case-Shiller just came out today for June and showed that home values, they accelerated. They went up 0.7%. FHFA showed 0.3%. But just take a look at this chart. So this one I really like, and it's a great one to share. Happy to share it with you guys because people now are still fearful. Hey, am I making a prudent decision with my money to buy a home? Yes, it's more expensive. Yes, it's hard to find a home. There's not a lot of inventory and rates are high. But are you better off waiting? Well, let me show you what the opportunity has looked like and what we're on pace for this year. Case-Shiller, FHFA, CoreLogic, Black Knight, Zillow. These are really the top 5 appreciation reports out there. You could see as of January of 2023, that was really the inflection point. February, March, April, May, June. Remember, this data does lag a little bit. So the latest data is for June. I know that we're here getting into September, but we've continued to see this happen. You guys see what's happening in your markets. You can see how home prices have gone up each month since January, and they've actually accelerated in most of these reports. And you see on here where I have the yellow highlights, that is when within that report, they set a new all-time high in home prices. So all these people talking about a housing bubble, well, FHFA reported home prices set new all-time highs in February. CoreLogic and Black Knight in May, Zillow in June, Case-Shiller, it is flat from the peak in June. So the next report is going to show all-time home values. And if you look at the first 6 months of the year, how much appreciation we've seen, and you annualize it, we're on pace for anywhere between 5 and 10% appreciation. I don't know about you guys, but I haven't really seen things slow down through September here.
Yeah.
So, I mean, I think, our forecast was somewhere around 6% for this year. But, the problem out there is that you have no inventory. And even though homes are more expensive, you still have much more demand than supply. And that's going to bid prices higher. One of my favorite tools that we have on MBS Highway is our cost of waiting analysis. And, it's worth showing you guys this just just so you can see
I
like
love,
how.
as you're pulling this up, I share a story where I had a client call me yesterday, and they're thinking about buying a place. It was gonna be an investment property, and they're like, well, should we do it now or should we wait? And I go, well, the advantage of, buying it now, yes, the rent doesn't quite cover the expenses, but you're getting it at the price today versus what you would pay for it later if you wait. And they're like, that makes total sense. So that I think that pushed them over the edge, that they're going to do the purchase now versus purchase later.
Well, and there is, I love the appreciation, I do, and especially moderate appreciation, not 30%. But
Well,
I mean, do you think we'll ever get back to the point where, instead of thinking, oh, how much am I going to make on this house? I'll be thinking, oh, maybe I should buy a house so I have a place to live, or maybe the backseat of my car is big enough to live in. I mean, why are we so focused on an asset that you may or may not sell for the next however long? I mean, I love the appreciation. And by the way, Dan, I learned how to use this little tool recently. Thank you
This
very
is the
much.
cost. This is the cost of waiting, right?
It's a miracle. Yes.
So this is like, whether you use our tool, we'd love to have you as a part of the MBS Highway family, or whatever. I think this type of way to approach it and explanation is key, because there's several challenges we're facing today and your realtors are facing, but certainly one of them is people wanting to wait for rates to come down before purchasing. You can certainly just say, oh, you should buy now, but I think it's really impactful if you were to show them something like this. People are visual learners. So here's how I would break it down. Mr. and Mrs. Customer, the home today is $600,000. And you mentioned you wanted to put 10% down. So the loan amount will be $540,000. And unfortunately, rates are 7.5% today. Now, if you wait 1 year, let's say you're right. Let's say rates come down by 1%. Well, your rate would be 6.5%. But remember, home values have been appreciating over the next year in your zip code. They're expected to appreciate by 6.3%. That has a meaningful impact. That $600,000 home, it would be $638,000. And because you still want to put 10% down, you're going to have to borrow more because the home is more. And you're going to have to come up with a little bit more of a down payment. So let me just analyze for you if it's worth it for you to wait. Well, if you come down, if you wait for a 1% lower rate, you'd save $134 a month, or over the 12 months, $1,600 based on that 1% lower rate. It's not as much as you think, because remember, you have to borrow more when the home is higher in a year from now. But you're right, you'd have a savings if rates came down. But here's what you'd miss. You'd miss out on $38,000 in appreciation. And you're renting right now, giving all that money to your landlord. Well, you'd be amortizing this loan and building equity to the tune of $5,000. So you'd miss out on $43,000 to save $1,600. Now, listen, when rates do come down, we could always refi you. Let's say that costs $5,000. So $7,000, you'd be at $35,000 to the plus side by buying today, because the appreciation is going to dwarf the interest savings. And then we could always refi and your rates come down. This is the kind of conversation that I would be having with customers, because I think it makes a lot of sense, and it's something that they can relate to and understand. And then don't forget, when rates do come down, everybody's going to have the same idea. I mean, if you think it's a competitive market right now, how many people are going to be out there shopping for homes, and you're going to see even more multiple offers and bidding wars than you are today when rates do come down to the low sixes, let's say, right? So, that's how I would approach that.
Yeah, no, it's a great tool. And it's something, I mean, the conversations we're having with our borrowers are fascinating to me, because people are very entrenched in. I talked to a guy yesterday who called. I've known him for a long time, and he's very thankful for the 2 7/8 rate I got him into. The problem is, he didn't call me when he got in trouble with his $40,000 worth of credit cards. And instead of doing, I don't know, anything else, he decided to sign up with some schmo who called him on the phone and said, hey, I can settle that stuff for you. And now his credit score has plunged. I am not joking, 300 points. It is ridiculous. And so, and he's still like, okay, he has ruined his credit. He is not getting a HELOC at this point at all. And so I'm just sitting there going, I'm like, I wish you'd called me sooner. I wish you'd, and he goes, so do I. But he's so like, but I don't want to get rid of my,
I want to hold on to my stinking ship.
Oh my God. Like, seriously. So again, like, to the point, we've talked about this before, where we got to make outgoing calls, like call people. I mean, have you seen the I've maxed out my credit card index? That's a new one. And
I haven't seen that, but
yeah, it's a new one.
That's a good one.
It is all over the place. Like, people are seeing it because they've been living large. I really think that people got so used to just having all this extra income, they were getting, stimulus money, and they didn't have to pay their rent or their mortgage or their student loans. And so they got used to, I don't have to cook. I can go out to fancy dinners all the time. I can buy whatever I want. And so they weren't quite ready to give up that lifestyle. And I think that the limit is going to end up being, I can't pay my credit cards anymore. I
Well-
don't have any more available credit, and now I'm screwed, and I better do something. And so get to them first.
And then next month, what's coming? Or October 1st?
Yeah.
Student loan payments are coming back.
Yep.
right.
Yeah,
That is gonna-
those are all good points, guys. One of the things that's been, what appears to be a bright spot in the economy that many people look at is the consumer still spending, right? And if you look at some of the retail sales numbers out there and such, it's still been pretty decent.
Yeah.
But what are they spending it on, right? And I think your points were great there, Audrey and Kevin, where number one, they got used to all this excess in the system from Stimmy 1, Stimmy 2, Stimmy 3, right? And that's now largely been dried up, right? So they no longer have that, even, kind of relying around at all. But they've been putting things on credit. And if, I didn't see that, I maxed out my credit report, credit cards, but I see a lot of other reports out there that kind of echo similar thoughts. Outstanding credit card debt is up, over 20% from last year. The average debt per card went from 4,000 last year to 8,000 this year. Delinquencies have like almost doubled, from low rates, but still, I think it's pointing to the fact that the consumer may not be able to spend much more because credit cards have a limit. And now remember, the big thing is since the Fed has hiked 525 basis points, servicing that debt has gotten much, much more expensive. So that to me is another recessionary indicator, because when they hit that wall, you're going to see a lot less consumer spending. Now, the other part of it, Kevin, that you were just mentioning, was student loan debts. And, that might have a little bit of more of a longer tail on it, meaning it might not have the direct impact yet, but as of September 1, credits, it starts accruing again, right? As of October 1, the payments resume. I think that could have a negative impact, but they have a year leniency period, which means that it won't start negatively impacting their credit until the following October. So, how some people are going to start paying it, and that's going to reduce their discretionary spending on other things. Some people may not, so it may not have the full direct impact immediately, but eventually that will become.
It will.
That's
And
good information. I didn't know that.
yeah, that's interesting. It's and the other thing too is a lot of people that are setting up payments now, they're basically negative AM payments, where they should be making a payment of $500 a month, but they're setting up a payment of only $200 a month. I can afford $200, but they don't realize that they're adding $300 in balance every month to their student loan debt. I'm like, that's going to come back and bite you.
Well, yeah, and people have a big debt problem right now. I was looking at, it's not like uncommonplace for somebody to have $40,000-$50,000 in credit card debt today, and it brings up a way that you could generate more income. Now, listen, I want to preface this: this is not going to work for everybody, but if you're looking for ways to generate more income now, and there's a ton of our customers at MBS Highway that use our debt consolidation tool, and they're getting an extra 2-3 deals a month when they really need it right now. And they're doing it by calling their past database and by seeing, even if they're at lower rates, if it makes sense to do a cash out refi into a higher rate to consolidate debt. Now, again, this isn't going to work for everybody, but if they have a bunch of credit cards that they're only making the minimum payments on, and they're never getting out of this debt, and if you can consolidate a few $1,000s a month in payments, even to a higher rate, it makes a lot of sense to free up that cash flow for them. Of course, there's always a risk they can go and remax out these cards again, which would be terrible. But that's obviously not what it's intended to do there. But people are really saving people a lot of money in cash flow, and then with some of that savings, applying it towards principal and paying down that mortgage and getting them more equity. And one of the lines we like to say is like, the last time we did your refi, we saved you in rate. This time we're going to save you in time, right? So just some ideas out there, and you can also do this with a move-up purchase, because most people, you guys know what they do. They sell their home, they take all the proceeds from that home, they put it down towards a new home. But because they're moving up to a more expensive home and rates are higher, they're getting a lot of sticker shock. Maybe it's $2,500 a month more. Well, they don't have to put all that money down from the sale, but you need to help them visualize it, right? Maybe they have $50,000 in credit card debt, put down, up to, so you have like 20% and you don't have
Right.
mortgage insurance, pay off the debts with the rest of that. And on their overall obligations, maybe it's only $500-600 a month more to get into the home of their dreams, even at a higher rate. And then of course, when rates come down, we'll refi them. So listen, we got to be creative in a market like this. I think it's important to, try to reach out to people for debt consolidation, move up, purchase. I know it doesn't really help you, but in those that it won't work for, maybe a HELOC would be a better option. It depends how much debt and what kind of debt. Remember, those rates now are close to like 9%. But another thing is you want to make sure that you are building, new relationships with realtors, and that you want to make sure that you're keeping a moat around your current ones. And you can't just, say, hey, let me take you to coffee, or here's my card, some of your business. There's a saying that I use often, and it's, every battle is won or lost before it's fought. And many of the LOs I see out there aren't winning the battle before it's fought. And we need to make sure that we are valuable to our realtor partners. And that means, doing things, a lot of people I talk to now, they sit at open houses because most of those people there aren't going to be getting the home, obviously. And those are all leads for them, but also helping the realtor sell the home, right? So giving them open house flyers, giving them reports like the cost of waiting, like a buy versus rent, like a real estate report card, to show those buyers what the opportunity is and why they should be buying a home, even if they don't get that one. So, you got to get creative.
Exactly. And just remember that if you're not calling your borrowers, the call centers are 100%. So we want to take a minute. We are really careful about not gossiping on this show. We hear things constantly that we don't ever talk
Good
about.
stuff too.
It's just not. What did you say, Kevin?
I said some good stuff too.
Oh my God, Kevin, I have to completely slap some painter's tape on his mouth to keep him from saying things sometimes. But anyway, so there is something going on though that was worth mentioning. Change Wholesale is in a little bit of trouble, as you may have noticed. So they
Not
stopped.
a little bit, a lot of trouble.
Okay. Pipe down over there. So I'm going to tiptoe through this and I'm going to see what Kevin's response is. So it's important to know what's going on, really, because one of the stories that is out there, they stopped funding for a while and they're going to come back, and it doesn't look like that might be the case. So they did lose their ability to do the CDFI loans. They were supposed to be serving the underserved with those loans, and that appears to not be what was going on. There was an article in a major publication, in a major mortgage publication yesterday, saying they had lost their license to do non-QM loans. And
I'm gonna stop you there, right there. There is no license to do a non-QM.
Okay, that was literally the next words out of my mouth.
You don't have to have.
Okay, so what happens is you don't have a license to do non-QM, as Kevin wanted to point out. Look at him. He's gleeful.
Oh, I just love
Kevin. I'm going to give Kevin the credit on that one.
Oh, for God's sake. Okay, Wall Street investors don't want to buy loans at this point. So they didn't lose their license. They've lost their ability to sell those loans on the secondary market, is my understanding. So they were
why did they lose that ability?
What?
Why did they lose that ability?
So they were supposed to be serving the underserved with the CDFI loans. They were supposed to be doing that with a mix of products. But what they ended up doing, from what I have read, is they were putting most people into the highest price loan with the least amount of documentation. So they were supposed to be doing one thing and they were doing another. So they were doing it. So the last audit they had, they were at 90% of the loans were that type of loan, the high price, but low documentation. But they were you didn't have to qualify people, right? So the next time around, they were at 97%. And the joke is, the thing that blows my mind about this right now is that it was only a quarter savings in rate to have them just say they weren't minorities, but that's not what was apparently going on. And so there's a bunch of crazy shenanigans going on. You can see some things on LinkedIn that will blow your mind. I won't even get into that. It is nothing. It's nothing that we want to see in the mortgage business.
Yeah, Audrey, some people are asking for the name of the wholesaler.
Change.
CHANG, like small change.
Or big change in this, they were doing a lot of loans for the underserved in very, very affluent areas, a lot. So, responsible lending is what we're supposed to be all about. And, and if it goes out the door and you've got people who are just like, I can close it, so I will, it just harkens back to the old days. So just be careful. And I keep teasing my buddy who also does CDFI loans that they're now going to require a 23andMe to validate your minority status before you can, that'll be a prior condition. But anyway, so again, like what bothers me about this is that we really need to be looking out for our borrowers. And if you can fit them into a different program and charge them something less than the highest price, you should be doing that.
Yeah.
And just because it's easy doesn't mean that that's the way forward. That's not what you should be doing. And so it's interesting because as those loans are going other places right now, strangely, a lot of them thought that they could only do that one program. They should only do that one program. And they're fitting into a lot of other different programs that have lower rates and better terms for the borrowers. And that is what we're supposed to be about. So not to be, I will get off my soapbox and see what else Kevin wants to throw in a mix at this point. But it's, we need to be doing what is right for our borrowers, for God's sake.
No, I remember back in the day, this is way back in the day when there's a company called Countrywide, and I submitted a B paper loan to them. And they came back, said, you know what, we can fit this onto A paper and save your client 2 points. I know, and ever since I did that, and I started sending them more loans because I knew they would take care of my clients.
Wow.
Yeah, that's how they're supposed to be doing it. Not, we can't do it this way. Let's underwrite it this way. We get more money.
Wow. Yeah, exactly. Well, conversely, I had submitted a loan. I was going to send a loan to Chase back in the day before the meltdown, and I had full doc. I was ready to go, and I was literally told, "Don't send us all that documentation. We don't want it." And I'm like, "Oh my God, really? Okay."
Unfortunately, the problem in the mortgage world is the poor loan officer makes more money than the smart professional loan officer, because if you put your client into a higher rate up front, then you have the opportunity to refinance them later on. You get double dip on the deal. Versus if you're a good ethical loan officer, you put your client to the best deal possible. You wipe out that possibility of screwing them on the second round.
Well, I think with rates where they are now, you're gonna have a good opportunity to refinance.
That's absolutely true.
Although, if you saw Dave Stevens' little piece on LinkedIn, and we do love him, I mean, he was saying that, expect things to sort of stay where they are for the rest of the year, potentially, and then really be in the 6.5 to 7.5 range, right? Like,
that'd be nice.
Wait, maybe I should read that. Hang on, let me make sure I didn't totally screw that thing up.
Listen, David's great, and it's certainly possible. I mean, nothing's off the table with where, things have been this year and some of the forces out there. But, if you do believe there's going to be a recession, think you'll see rates come down significantly, as they always do. If we get a Fed that, stops pressing forward with their tight monetary policy, maybe eventually starts easing a bit, and, you continue to see inflation come down and you start to see the jobs numbers weaken, I think we could see a nice rebound. So it's going to depend on a few things, but the big one always is, during a recession, the economy slows, spending slows, inflation comes down, things like oil prices and such come down. There's less demand for things. And, interest rates, if you just look at a historical chart of, rates, mortgage rates, 30-year fixed mortgage rates and recessions, they always decline significantly. So, that's kind of like a silver lining, is that, recession is never something that is a good thing for the economy overall. You hope for a mild recession. But I think, it could be necessary to get some of this inflation completely wiped out. But it would be a silver lining would be rates would come down. Now, some people worry about recessions and they say, well, what does that mean with home prices? Well, if you look over the last 9 recessions that we've had, home values have actually gone up during all of those recessions, except for one, and that was the housing bubble that led to the 08-09 recession. That was very different. We've talked about how, opposite things are today than then, from a supply and demand standpoint, from a loan quality standpoint, from vacancy rates, from every metric you look at couldn't be more opposite. But the part of the reason for that is because when you have people lose their jobs, let's say the unemployment rate goes up by 1%. Well, now you have a little over 1 million people that are no longer in the market to buy a home. Now that's, I think, a little bit of high of a number, because not all those people that lose their jobs are going to be in the market to buy a home, or maybe could qualify even. But let's just say it was 1 million. Some stats from Black Knight show if rates come down 1%, 5 million more people can now qualify for a home, right? So you have that kind of tug and pull where, maybe you have a little over 1 million people that are certainly not in the housing market if they lost their job, but you have a lot more people now with rates coming down that can qualify. And for that reason, you typically see home values do quite well during a recession
That's
if
a
you remove the anomaly.
really interesting comment. I like that comment.
Yeah.
That is brilliant, actually.
Mhm.
That as rates go down because of recession, even though 1 million people lost their job, 5 million more people can buy a house.
Yep.
Wow.
And just to correct myself to make sure that I'm not misquoting Dave Stevens, he had said that it was unlikely mortgage rates would revert to the 5.5% levels of 2022 until
go.
inflation has moved closer to the Federal Reserve's 2% target, et cetera, et cetera, et cetera. And he said a more likely, and I am summarizing, a likely scenario is that mortgage rates continue to hover in the 6.5 to 7.5% range for the remainder of the year, which means affordability will remain a challenge. But I mean, this is a guy who is very good. He's very good at looking at the good and the bad.
Yeah.
And being pretty even and just saying it like he thinks it
Well,
really is instead of pussyfooting around. So,
I'm sure everybody on this call will be happy with 6.5 at this point, right? I mean, I
right.
think that would be quite a different market, right? But of course, if we can get a 5 handle on it, that would be fantastic. But even at 6.5, I think it's a different market. Affordability is certainly strained right now because of higher rates and higher home values. But one thing that I don't like that the media does is they don't really, I think, look at the whole picture. And
No.
what I mean by that is there's no question affordability is worse, but they never take into effect or into account that incomes also have been going up at a pretty high clip, which, listen, again, I'm not making the argument homes are more or a lot less affordable, but just look at the full picture. And to some degree, that does mitigate some of it. Because remember, one of the things the Fed didn't like is how much incomes were going up. According to ADP, they were going up like 8% a year last year, and now they're at like 6%, right? So I know other costs of goods and services have gone up too, but there certainly is a little bit of a mitigation when they're doing their examples for how affordable homes are based on the rise in incomes, if that makes sense.
I keep wondering how some of these prices are going to moderate, though. I was having a burger at a pub in San Francisco last week with one of my kids, and we were talking about how the hamburger we were eating that was $18-19, like not too long ago, was $12. And even that's kind of crazy for a hamburger, right? It was literally a hamburger. And so I walk out of there.
$10 at a fries machine.
Well, guys,
Yeah,
here's
so
the crazy.
we did not have drinks. We both were drinking water, and we just had it cost me almost $50 for that whole thing. By the time you add in their tax for this and that and all this crazy. So my question is, I mean, when was the last time you saw them reprint a menu to lower the prices, right?
Well, here's the
So
thing. Most people
how's
don't
that going
realize
to happen?
Most people don't realize this with inflation. The Fed, a banner year for inflation is for prices to only go up 2%.
Right.
But that doesn't mean, like, when you see inflation coming down, right, from 9% to 3%,
That means
those gains are locked in, baby. Meaning, like, home prices the cost of goods and services go up, and then you're looking for a slower increase going forward. Unless you get negative inflation, which you don't see often, the values never actually come back down. They just go up at a slower clip. And then, I mean, just think about, how much did it used to be to go to a movie, a nickel or something, right? The prices always go up, the incomes always go up, but you want that to be a more controlled rise. But, unless we see negative inflation, you're not going to see those burger prices go down. They're just going to go up at a slower clip, right? So it's something interesting to think about. But
I have been thinking about it too much. Driving me crazy.
I'm pretty sure I'm not going to be paying $5.39 a gallon as soon as summer season is over.
Oil prices are different, right? I mean, oil prices are certainly something that, depends a lot on, how the economy is doing for demand, but also it depends on supply. What is OPEC Plus going to do? Are they going to cut production? Are they going to produce more? Is the U.S. going to fill their SPR, Strategic Petroleum Reserve, like they've been saying they're going to do? That would certainly push prices higher because that's a lot of oil that we need there to refill those coffers. But yeah, oil prices certainly would be an exception to that because you can see them go down or up significantly. But overall inflation, you don't see negative inflation that often, so.
Right. Well, and that's not good either. So we talk a lot about what you should be doing. I'm going to give you a little example of what you should never, ever do. As a loan officer or a realtor who is feeling a little desperate in these weird times where closing loans is not as common as it used to be. So my mom, who is a lifelong realtor, was sitting in the car wash line, and this man approaches her and starts talking to her, hands her a flyer because he's a realtor and he wants to sell and buy, like help people buy and sell their houses, of course. So my mother, chatty Kathy, go figure. I mean, she starts talking to him anyway. So what started off as hey, I'd like to buy or sell your house, turned into somehow she mentioned she's about to list her house. So he all of a sudden is like, wait, your house? And he jumps on it. And by the end of this thing, he was begging her in tears, like literally had tears in his eyes, begging her for the listing. So this was a bit of a turnoff. It never even occurred to me that someone would do such a thing. They do, and they did. Don't do that. Don't be desperate. Whatever you got to do to like get yourself all primed up before you go out and meet people face to face or even on Zoom, do something positive so that you're not crying and begging for their business. That apparently doesn't work.
Oh, he didn't get the listing?
What?
He didn't get the listing?
He did not get the listing. I mean, really, who wouldn't want, somebody who's desperate and crying, selling their house for them, right? Good Lord. Good Lord.
Hey, Audrey, before we end here, one thing, I wanted to just share with everybody is I think how important it is in today's day and age to make sure you're getting out there on social media, make sure that you're showing that you're the expert. You're talking about the opportunity in home ownership, maybe negating some of this negativity in the media. And, just something that, listen, I don't originate loans, but I do this for people to kind of take this stuff and share it. Thousands of people will just kind of post it on their story and strum up some business for themselves, or you can just rip it and just do your own version of it if you want to be the one saying it. But just to show you, my Instagram is the Dan Habib. And I have tons and tons of these videos that people tell me that they love to share because it shows why you shouldn't wait for lower rates. So, why, what the cost of waiting is, is buying a home a sound investment, you name it. I have a ton of these videos on here that are literally for you to just go ahead and share. Again, it's the Dan Habib.
Well, and I will say that Megan Anderson has helped us from the very beginning of us doing the show 3.5 years ago, many times coming on, showing how to do videos, and every single week when we're doing the show, we keep in mind giving people little bites of information, something you could post on social media that counters maybe some headline that's out there or some misinformation that's out there or some good thing that's happening, like home prices are not 30%, appreciating 30%, but they are still appreciating 5 to 10%. And all the doom and gloom is a bunch of bupkis. And while we're on it, I have a brother who made a point when things were seem to be going to crap and the prices were moderating, that he was right, I was wrong, that it was going to crap, the market was going down, his values were going down. So if you could come to Thanksgiving with me this year, Dan, I would really love it if you could just, because he made the point of going and just, I don't like to say that I'm right. And, and then repeating that 3 times so that everyone's listening. So yeah, if you could just join me this year, you'll love it. Lovely.
I'm a big stuffing fan. So if you guys have some good stuffing,
the food.
I could be swayed.
It's all about, we're Italian. It's raviolis and and prime rib and ham.
I made a prime rib last year. That's my favorite.
Yeah. So there you go. So we are in good. So overall, just to summarize, things are not bad. Things are actually good. And we have less competition in the market between, loan officers because there are less of us. And we have people who need to buy houses and everything is looking for, good in the future. So position yourself, keep doing what we talk about every week. Dan, we love you. Thank you very much for coming. The timing could not have been better because it looks like
I don't know how you do that, Dan. You knew that weeks in advance.
Listen, hopefully the next time I come on, we'll have some really good news to talk about. And maybe
if I call you and it's red 911, I'm going to be like, hey, the market looks like crap. But if you come to our show, it'll be better.
Yeah,
we'll make that happen. So anyway, all right, kids, we'll see you next week with Dave Luna at the same time, or you can find us on YouTube. Share us with your friends. Thank you, Dan. Have a great week, guys.
Bye, guys. Always a pleasure.